Dave, what's your view on equity markets?
Yeah, so we've seen a phase of very strong equity returns, and this has been driven by PE multiple expansion. So in a sense, you can think of this as equity investors getting more comfortable again with owning equity. So we've been through a deeply traumatic phase for equity investors with lots of volatility and negative returns, and now we're seeing a more helpful, constructive phase, and what we've seen as a consequence is yields on equities fall. Now that in a sense is reducing your prospective return as we get more comfortable. But I think the key question is to ask yourself, is that now too far? Have we gone too far? Are investors too relaxed and too optimistic about the equity? Our view on that is to still be relatively constructive and to say actually we've normalized in many situations, particularly in developed markets, and so you're set for more normal levels of return. The US equity market tends to look more expensive relative to most of the other markets, but even there, our perspective would be that returns are relatively close to normal. And in particular, we still think we're very well supported by the dynamics of company profits and what they're managing to do, and very importantly, very low inflation, which is allowing the flexibility to keep interest rates low, which both supports economic growth itself, which is good for the equities, but also supports the valuations as well.
Do you share that view in terms of bonds?
Bonds are more problematic. So bonds are the flip side of this more relaxed, complacent or confident view that investors may have had over the last period. So in bond markets, you've seen a bit more trauma. So as the US central bank has talked about removing or reducing some policy stimulus, bond investors have worried that that is a turn in the interest rate cycle. So if you've owned longer dated government bonds, loans of 10 and 30 years, it's actually been a very uncomfortable place to be. Now our sense is that those assets have already interpreted or anticipated some of that imminent and likely ongoing change in interest rate dynamics. And so actually they're relatively close to normally priced again. So owning longer dated government bonds as part of an overall portfolio to us doesn't seem like an unattractive place. Again, I would highlight the fact that cash today, relative to bond and equity, still looks like it's your enemy. It feels safe to own cash and cash proxies, but with inflation at 2% and interest rates at 0, the real value of your capital is decaying over time, and it's decayed materially in recent years. So we would be strong proponents of the idea that you should want to buy baskets of diversified assets. Selectivity within the equity universe is tremendously important. There are some very different dynamics occurring, but in aggregate we think equity is still the place to be. And certain parts of the bond market's yield curve and in credit markets we also think are attractive as well. So again, our sense is put cash to work in both fixed income and equity assets. Be prepared to tolerate and accept some volatility, because the sustainable rates of return that are on offer today are, in our view, still attractive.